Very enthused, Cameron, I love it. So we'll hear from them shortly, and it'll be about sort of 5 to 7 minutes from each speaker. Then I might ask a question about clarification, and then we'll open it up to the floor afterwards for audience questions and a little bit more engagement. So just a note to make it clear, whilst of course we've got a lot of top paraphernalia around, and we've got Geoff Simmons speaking as leader of the Opportunities Party, and myself involved and supportive of that. The rest of the panellists here tonight are not in any way politically associated. They've very generously agreed to give up their time and basically in pursuit of what is a much needed broader discussion around tax in New Zealand. So thanks to them for giving up their generous time. So basically, I'll introduce the four of them, and then we will hear from them each individually, and they're going to take a different approach to what they're speaking about, which will be really good to hear. So we've got Dominick Stevens here, who is the Chief Economist at Westpac, and we have the talented Susan St John, who is an Honorary Associate Professor at the University of Auckland, and also a recipient of the Queen's Services Order Award. And we also have Terry Baucher, who is a tax specialist, and he was just telling me before, he's the director of Baucher Consulting, and they've been around for about 15 years, and he has had about 35 years experience in tax. And then of course we've got the legendary Geoff Simmons, leader of the Opportunities Party. So we'll hear perhaps from Dominick first, but once again maybe Terry first, and then we will move through them and ask questions as we go. But once again, a quick round of applause, because we're really lucky to have such a diverse and skilled panel here with us this evening.
Kia ora tōtou, kia ora tōtou. Ko Terry Baucher tene. Apologies to any Te Reo speakers for butchering your beautiful language. My name is Terry Baucher. Good evening. I'm a tax nerd. I'm such a nerd, I wrote a book, quick plug. It's available for $10 afterwards. But it's actually, to talk about the book, it's quite interesting, because Deborah Russell and I, who's now the MP for New Lynn, wrote that 2 years ago, prior to the delivery published right up to the 2017 budget. And looking back on this, really interesting to see what we put in there and what issues have now been addressed or being addressed or could be addressed depending on which way the government wants to go. So what I thought I'd talk about in my brief thing here is sort of big picture stuff. What was in the tax? I'm fed up talking about capital gains tax. That's all I've been asked about as a specialist on that. There's so much more in that report, and I want to raise a few of those issues with you. But just for the record, I am a capital gains tax purist. I would tax everything, including the family home. And as I said, read the book. It sets out one of the reasons why we should do that in there. So I'm a purist, tax everything. Broad-based, low-rate approach, which is endorsed by the tax working group, that's in essence how it should apply. You only get a low rate if you tax everything. GST is a good example of how we do that. And GST is applied on everything. You can't all hear me at the back. I know I'm quite soft-spoken at times. Can you hear me at the back? Do you want to hear me at the back?
Do you want to even pull it out and just talk into it? Sorry.
Right. Okay. I feel like a stand-up comic on stage. Yes. Okay. Can you hear me at the back? Good. Good. So you missed all my rumblings and ramblings at the beginning. So, just to clarify, I'm a capital gains tax purist. I believe in taxing everything, including the family home, and on the broad-based, low-rate approach. My view is that not having done so has been damaging to the New Zealand economy for a long time. Andrew Coleman put it really neatly. We discussed it in our book about what happened, what we think is happening there, how investment has been diverted on. Dominick will probably talk more about that. That's all I'm going to say about it, because to be honest, I'm fed up talking about CGT, which hasn't happened. But one of the things I want to talk about is the group. Is it the future of tax is what it looked at. And there was a lot in there which we haven't really heard anything about because of the focus on the CGT issue. And one of the issues I want to raise is the question that came into the papers recently involving privacy. Inland Revenue has access to a massive amount of data, and it shares that data all around the world. To give you an example of how that works in practice, I'll tell you a story of a client who came to me. He had not disclosed some foreign investment fund income, horribly complicated story. Anyway, 22nd of December 2016, we filed a voluntary disclosure with Inland Revenue, then went on holiday. I get a letter dated 20th of January from Inland Revenue saying, thank you for your voluntary disclosure. We note your client has an interest in a rental property in the United States. Have you disclosed that income? So consider the timing. Over the holiday period, the information, we had actually covered it all off, but Inland Revenue knew that our client had an investment property in the United States. And it knew that because the US Internal Revenue Service told it, or it asked the IRS. And that's what's going on right now. All around the world, that sort of data is being shared freely and without any oversight. Big breath. Sorry, I get excited and then get short of breath. It's tough being a tax nerd, I'll tell you that. So, one of the things that I was lucky enough to actually get to work closely with the tax working group. I was actually asked to prepare a report for them on two particular parts of the tax system. An appeals system for small businesses, and secondly, whether a specific tax ombudsman is needed. Now, I raised that issue. This is the one I think the report went with the idea for a new appeals process. It hasn't gone with the tax ombudsman. The tax ombudsman, there is a growing trend around the world for specific tax ombudsmen. And for example, in Australia they have the Inspector General of Taxation who fulfills this role. And the reason they have that, and I think it's vitally important, is this question of oversight. Inland Revenue is sharing more data, has access to more data than any other government agency. And it's sharing it all around the world. And this is an issue that's going on with very little oversight. There's only, and that is a parliamentary issue as well. And it concerns me that our parliamentarians are not always on top of the tax issues because of the complexity involved, which is, to borrow a phrase, if war is too important to be left to the generals, then tax is definitely too important to be left to the tax experts. We need public oversight. And I wanted to bring this out to the fore because I think it's important for all of you to know exactly what's going on with your tax system. Who's actually administering your affairs? What data have they got access to? And how will that affect you? And this is going to get bigger and bigger as we go on. So that's one of the things about the report that's not been said about. It so happens that I'm lucky to have a good insider view of it. But I think for all of you, and all of us as citizens, we should be concerned about. And we should be asking and making sure our representatives are doing the job to make sure that Inland Revenue administers its duties properly. We really do have to get breathing exercises. The other thing, now it's become particularly important because one of the other recommendations that was made, and Susan, I no doubt will have something to say about this, is a proposal for a single Crown revenue agency, this collection agency. This agency will collect all debt owed to the Crown, rather than as now, Inland Revenue does its bit, MSD does its bit, and all the other ACC does its bit. 30 seconds, all right. You think getting on the roll, right? Okay. So that's the second point I want to raise on that, is this the main point I want to raise about who's going to administer it. The other thing about the future of the system, I want to throw something out there. We didn't really hear a lot about the future of the system. For example, do we really want income tax? Is income tax the future? What's happening with the digital economy? Is GST, for example, something that's going to work in the digital economy in space going forward? And I think I'll leave it there, and you can ask me questions later. Thank you.
What I found interesting about that was your discussion on data, particularly with, of course, the changes with the GDPR and everything like that coming in. So is it fair to say that how we approach that is going to directly impact the ability to implement tax within New Zealand?
The Inland Revenue basically knows everything. So clients who think they're going to run away from the Inland Revenue are just under the table are mugs, because it wants to introduce a complete withholding system across the board. It wants withholding taxes everywhere. You know how pay-as-you-earn is one, resident withholding tax on interest. It would like to do that across the board, all sorts of other payments. So for GST, contractors' payments. So it is going to get more data, and it's going to have, how that data is applied is going to be interesting going forward. But it's really going to be one of the areas that perhaps another area that's been neglected would be the dark economy, the cash economy. The cash economy is going to go out of business, is the long-term answer there. People are tradies, cash for tradies. That is something that the Inland Revenue is right now looking at. I can tell you plenty of horror stories of what I've seen, and we're going to see more of that. Is that clear?
Yeah, that's great, thank you. That's actually quite a nice segue into banking with Dominick Stevens. So we'll welcome you to the stage to talk a little bit about capital gains from a broader perspective.
Kia ora tātou, and thanks very much, Terry, and thanks very much for inviting me here. So just by way of introduction, I'm the Chief Economist at Westpac. I've actually decided to attend today on my personal time because this is an issue I'm really, really passionate about. And actually I want to take the opposite approach to Terry and talk squarely about capital gains tax. I've been sort of horrified and spent a lot of my time in the last 12 years working on the skews that the New Zealand economy currently has and the horrible skews that we see in our tax system. So the basic problem in New Zealand is we tax the income earned on investments and from capital, but we do not tax the capital gain earned on this. Now this has skewed our investment choices, and if we just start to think carefully about what are the big things, the big problems with the New Zealand economy that people moan about and talk about. Well, we've got a huge overinvestment in land-based assets, so residential investment property and farms. They're exactly the types of assets that yield a lot of capital gain and not a lot of income. They often operate at sort of 2 and 3% yields. You can get more putting your money in the bank. Well, why don't people do that? It's because they can get capital gain. We're concerned about sort of excessive debt, often secured by land holdings. Well, that's because by taking on a load of debt and buying land, you can minimise your income through tax-deductible interest expense, and you can maximise your capital gain. So people have done that. Of course, with land-based investment essentially being subsidised by the tax system, people have piled into that. Our balance sheet is highly concentrated, and we have a lack of investment in other productive assets. We have low productivity because we haven't invested in income-generating assets. And of course, because we're all piling into land, the price of land has been bid up due to the skew in the tax system. And then we're very concerned about housing and affordability, and actually, if you go outside of Auckland and you're down into farming land, you'll talk about sort of succession issues on farms, because farms are awfully expensive as well. So look, my view is we need to plug this hole. We really need to plug this hole. And what the tax working group has recommended is far from perfect. I think I've made myself the least popular person in the country by being the only person who has supported this. I've supported it in the sense that I've said I think it's better than the alternative. Okay, so capital gains tax that has been proposed, I would argue, will lead to a higher long-run living standard than if we do nothing. All right. So if you introduce a capital gains tax, what we're likely to do is, again, we're likely to fix that skew. So we're likely to have people investing more in productive assets, less in land-based assets. I do not believe for a second the tax working group's conclusion that house prices and farm prices would not be affected by the introduction of a capital gains tax. They absolutely would. A lot of my own research has been down that track. I read what they wrote. I found it not convincing. So in my view, you would absolutely see a drop in house prices and farm prices relative to the counterfactual, which, by the way, has all sorts of transitory, that's actually a serious problem. Drop in house prices, drop in farm prices, you get people in negative equity, you've got a serious transitory problem as you introduce it there, but look, you've improved affordability in the long run. It's not perfect. what they've recommended. I was surprised to hear, well, Terry chose not to talk about capital gains tax. I mean, normally accountants hate it. It's complex. We're going to have all sorts of accountants running around administering people's tax papers. That's an utter waste of human resources. It's you know, there's no benefit to society from that whatsoever. It's also got lock-in, so people, you know, if you have a capital gains tax, if you enjoy a windfall gain in your property, you then don't want to sell it because you have to realise a capital gain and pay tax on it. Okay, so those are issues. But again, I argue that the waste of resources from all of those accountants running around is less than the misallocation of resources that this economy currently suffers from. The mass diversion of our investment funds from other productive assets into land-based assets. Okay? It is less costly than what we're currently enduring. Another, a problem with what they recommended that's already come up and been mentioned is the lack of taxation on the family home. So that's an ongoing tragedy. We have a situation in New Zealand where basically homeowners, i.e. the haves, get a huge tax break. They pay no tax at all on that investment. Those who never quite make it onto the property ladder, who never access home ownership, are left paying rent out of their after-tax income. And that is actually the wrong way around. The haves are being taxed less than the have-nots. It's not perfect, but I would argue, look, if you've got two broken arms and a problem with investment funds and a problem with lack of taxation on the family home, it's better to fix one than none. Okay? So yeah, there's the mansion effect with the capital gains tax, but that's there now, and it's not getting any worse. We have this over-investment in the family home. It's not going to get any worse with what's being proposed. Another feature that I think has been completely missed by what the tax working group has proposed, and it probably is the key feature. So all of the complaints and moaning that's been out there is, oh, it's going to disincentivize investment. You know, the people who've gotten ahead are going to have to pay tax. The electrician who's built up a nest egg and built up his business over time, and he wants to sell it at the end, and he's going to have to pay tax on that capital gain, and that's going to disincentivize it. Well, that's actually missed a really key point, which is that this is a revenue neutral proposal. So it's a reduction in income tax and an increase in capital gains tax. So that electrician will be paying lower income tax right the way through. Now, I'm not going to call it a problem, but it is a feature of what they've proposed, is that those income tax cuts are all at the bottom end. They're entirely for people earning between 14 and 48,000. Okay? So what that means is it's going to improve work, lower income tax rates at that bracket. You're going to improve work incentives there. But at the top end, where not the weight of people are, only a few people are, but the weight of money is, you are just essentially asking that end to pay more tax. It's buried beneath what they've proposed is actually a tax switch, asking the top end to pay more and the bottom end to pay less. And that's your classic left-right debate. It's not the place to sort of get into it, but it is true that if you tax the top end of town more, you're going to disincentivize investment. You're also going to create a more progressive tax system, and whether you think that's right or wrong depends where you sit on the political spectrum. It is true that this is not the only way to go about plugging the tax hole. So I'm horrified by what I see when I look at the New Zealand economy and how skewed the tax system is and what it's doing to the housing market. I do want to see it plugged, and there are other ways you can go about it. So I know the Opportunities Party recommended basically a wealth tax at the last election. So that would be, for a tax purist like myself or Terry, that would be much better. It's completely neutral as to where your tax dollar goes, so it doesn't skew investment incentives whatsoever. I'm not sure of the politics of it. I guess if Geoff, if you were in Parliament at the next term and it was yes or no on what's been recommended, and that's your only two choices, I'd say vote yes, imperfect as it is. Other alternatives, really what matters is the gap between your income tax rate and your capital gains tax rate. So we could lower income tax rates. There's another alternative. We could remove the inflation component of interest income from taxations. That would reduce taxation on sort of bank deposits and the like relative to investment in housing. There's a range of alternatives, but I guess my main point is, look, imperfect as this is, I think it's better than what we're currently enduring. I completely disagree with the minority opinion on that group who said that what we've got now serves us well. I think it's badly skewed, this economy. We've piled into houses and farms. There are social problems with that, economic problems with that. Plugging that with something is going to work, and I think what's being proposed is a good first step. Thank you very much.
Really passionate viewpoint and really kind of in line with mine, so that's nice. So in terms of talking about, I guess, you made it clear that you're basically in agreement that something's better than nothing. But what, is it enough? I guess is the question that I've got for you, or is it Kiwi Build 2.0? The second one's rhetorical, but.
Like I say, it's a better reception than if you talk to an employers group or a lot of the groups I've talked to around town on my views on capital gains tax. Is it enough? I actually do think that in terms of the social issues with our tax system, the lack of taxation on the family home is still a big glaring hole. So no, it's not perfect at all. We're still going to have a big hole in the tax system that people with enough funds can access and people with not enough funds can't access, and that seems unfair to me. So I would prefer to go further, but again, it's better than nothing. So, cheers.
Thanks, Dominic. We'll get you to part, and we'll welcome Susan to the stage. So I gather we're going to get a bit narrow again. So I've read a little bit of what Susan has produced, and really, really interesting viewpoint, and hopefully a very critical examination on the way. So I'll just pass that to you now, Susan.
It's really great to be here. Thank you for asking me, Geoff. When Geoff twisted my arm to come tonight, he said it will be light-hearted and fun. It's in a pub after all. Well, I have to assure you, Geoff, that there's nothing fun about the tax working group report, and I especially felt that when I inadvertently started to print it off, when I thought I was only printing a page, and I printed the whole damn report single-sided and in colour, and I couldn't stop it. So let's get down to the nitty-gritty though of this report. I wondered which lens I should use tonight. Should I put on my economist's lens, or child advocate lens, or retirement specialist lens? Just looking at it from a policy analyst's point of view, I was really pleased to hear Dominick starting to talk about the actual problem, because when we look at the tax working group, there's not a lot about the actual problem there. And when I look out there at the problem, like Dominick, I'm appalled at what has happened to the economy and how distorted it is. So we've got a housing boom, a housing crisis, which I would say parallels what happened in Ireland, except we haven't had the crash yet. So we're right at the top in terms of the speculative boom compared to other countries. We've got compounding gains at the top end, while we've got compounding misery and debt at the bottom, and an ever-widening wealth distribution. And a serious misallocation of resources. So think about the real resources, the building materials, the architects, the planners, the people who go and inspect, the building inspectors. All of those resources are being sucked in to providing high-end, elaborate housing. And therefore, of course, the price of labour and resources to fix the bottom end are being bid up all the time. So serious misallocation. I used to live in Epsom, and I went to visit my friend the other night, and she pointed out the house next door, which is a huge old house that's just been let to go to rat and ruin. It has had 2 overseas owners. It's currently empty. There are rats running around outside, overgrown mould inside. I would say pretty uninhabitable. Apparently it's on the market for rent at $980 a week. But it's been empty for a long time. Landlords are often not interested in actually renting. They're interested in the gain at the end of the day. And they're seriously undertaxed. So you can write off all sorts of things. Your interest income and all sorts of capital improvements, pretend that they're repairs and maintenance. And it really does feed into the accountants industry. So what did Labour really want from the tax working group? Grant Robertson wrote a letter once he had read the interim report, and I wanted just to read from it, because he requested that the tax working group consider a package or packages of measures which reduce inequality so that New Zealand better reflects the OECD average while increasing both fairness across the system and housing affordability. Now, I greatly admire what the tax working group have come up with, but they have not met that request. The final report doesn't have much discussion about what the actual problem is, and it produces a capital gains tax that only affects the future, capital gains made in the future. So we've had all the accumulated untaxed capital gains which have produced this enormous wealth divide, and we've got a tax that we might get sometime in the future, probably a limited one, because the comprehensive one I think would be just a one-way ticket to political oblivion. So a limited capital gains tax which is somewhere in the future and won't attack this problem of the increasing wealth divide, which will continue unopposed. So they proposed tax reductions, and I think it was Dominick that you referred to those tax reductions. Well, I found the analysis on a household equivalised income basis, and the tax reductions which arise from raising the threshold, the bottom tax threshold, 20,000 or so, actually deliver 5 times as much to the top decile as it does to the bottom decile. So it's not the answer to making it fairer. Grant Robertson went on to request that the tax working group examines whether a tax on realised gains or the risk-free rate return method of taxation, or a mix of the two, is best for extending a potential capital income tax on specific assets, with the goal of ensuring New Zealand's tax system is fair and balanced. Well, the final tax working group report is all about the capital gains tax. The risk-free rate method is just not given a fair run. And I think this is an enormous problem. Well, it's an enormous lost opportunity. So there's no clear rationale of the risk-free rate method. There's no explanation that if you've got net equity tied up in taxation, either you're getting a return because you're enjoying living in the house, or you could have had that money invested in the bank, in which case you'd be earning 3% and paying tax. So why not take net equity, treat it as if it's been put in the bank, and tax at 3%. That would mean if we adopted the risk-free rate method way, that we wouldn't need expensive accountants, because landlords would no longer have to put in a return of their rental income. They would be taxed on the net equity that they had, and it would mean that they couldn't generate rental losses. They wouldn't be forever arguing about the sorts of things that they could deduct. So what about the fact that actually the family home is exempt in the tax working group report? Well, I go back a long way with Michael Cullen, and I had a look at what he said after the 2001 report, and he described the risk-free rate method, by the way, as not dead but not kicking either. But his response to that report was to clearly take the family home off the table, and he hasn't changed his views. And I don't think that the tax working group were able to challenge the government and say to the government, this isn't good enough. We have to have the family home in there. You can build in an exemption, either with a capital gains tax or a risk-free rate method, that means you're only going to affect the top 20% who've got the mansions, so that most ordinary people aren't going to be affected. The government hasn't been told that, and so we've ended up with a Mickey Mouse capital gains tax, and we've got this completely analysed risk-free rate method, which has all sorts of clear advantages. And I actually do like the Minority Report. I think it's realistic, and I want to finish with a quote from the Minority Report. If unaffordable housing is the problem, the capital gains tax proposals are unlikely to provide the solution. If gains from residential property are to be more fully taxed, then this could be done with some modifications by extending current rules, including bright line tests. Well, of course, that seems to be the obvious, logical thing to do. They go on to say, alternatively, we consider that a simpler solution could be to apply the risk-free rate return method or something similar to residential housing. This method taxes net equity as an asset at a fixed rate each year. Extending the tax base in this more limited way would generate much of the revenue expected from the comprehensive capital gains tax proposal. So my contribution is to say, what a shame that we didn't have a proper analysis of how many pages, 800 pages long, as we've had for the capital gains tax of the risk-free rate method.
Key ideas that everyone has been thinking, who has taken the time to kind of read through the report, and I think that 80% to 20% piece is an option. So is it fair to say that essentially the current proposal, as you alluded to the mansion effect, is it fair to say that that current proposal is just going to encourage more and more people to, move down that mansion pathway and therefore sort of basically be able to work around the whole solution?
Yes, absolutely, and that's what's happened in Australia, of course. But when we look at where the net equity in owner-occupied housing is held, it's basically predominantly held in the top deciles. So that's what's escaping. It doesn't seem logical.
Cool. Thanks, Susan. Essentially, you can just build your house bigger. Okay, and now we'll hear from Geoff.
Hey, I just want to start. When I first suggested let's have a session about tax in a pub, everyone laughed at me. They thought no one would turn up. So big round of applause for yourselves for coming out tonight. David, can we turn that camera around and show people that we actually have a whole pub full of people that give a shit about tax? This is really impressive. Sorry, if you wanted to cover your face, then that's totally understandable. And can I... Amy's going to do thanks at the end, but I really want to thank everyone that's helped us put on this event. This is, Opportunities Party is no longer funded by Gareth Morgan. We're a lean, mean group of volunteers, and Amy, Cam, David, and Mark have all, and their teams have all helped, get everything that you see here today. And of course, thanks to the Great Honorary. So big round of applause for all of them. Cam was just getting a beer while I was thanking him. Yeah, thanks. Okay, cool. So, just to cover some of the things that haven't been talked about tonight, I just thought I'd start by talking about the environmental side of the Tax Working Group report, which is actually really excellent. They did a pretty good job. The trouble is that they put most of their effort into designing a capital gains tax rather than fleshing out some of their excellent views on environmental taxes. If you look at the tax of the future, as Terry talked about, we have massive challenges about where we're going to get our tax income in the future, particularly if we're going to meet our environmental challenges. People talk about the biggest challenge for the circular economy. You guys know what I mean by the circular economy? Making sure we don't chuck anything away, basically. The biggest challenge for the circular economy is actually income tax, because recycling, reusing, fixing old stuff, it all takes labour. Whereas the linear economy, the chuck away economy, is done by machines. So, and that's all been driven by the tax system, which really hammers the tax on labour harder than the tax on capital, the tax on profits, if you like. Around the world, that's generally the case. So there's a lot of economists thinking for the circular economy, we're actually going to need to drop taxes on labour. Where are we going to get the money from? Environmental taxes is an important part of that. Some really good thinking in this report on that. Encourage you to take a look at it. Things like prices on water, things like prices on water pollution, things like ramping up the emissions trading scheme price, the price on carbon, congestion charging, a far better way of raising money for transport than whacking a tax on petrol, which is a very regressive and blunt tool. So lots of really good ideas in there. Sadly, they put most of their effort into a capital gains tax, so that is what we're all focusing on as a result. Look, Dominick and Susan have really talked about the problems and why we're in this mess at the moment. And it is a lot to do with our tax system. Yes, there's some problems in our planning system too, but the problems with our tax system are driving house prices up. They're driving the increase in inequality. The increase in inequality in the last 20 years has come entirely from higher house prices and rents rising faster than the incomes of the poor. So the after housing cost income of poor people has gone down in the last 20 years. So that's what's driving inequality. And of course, driving the poor productivity, as Dominick so clearly outlined. Don't disagree with any of that. And the issue there is that we tax the returns on the investment in property at a different rate from what we tax the returns on the investment in basically everything else. Bank deposits, businesses, shares. The tax working group said this. So how property, and you can include farming in that, as Dominick said, has been the big anomaly. Okay, whether that's investor property, owner-occupied property, or farming. That's been the big anomaly, and that's where we've seen the big tax-free capital gains. This has already been touched on, excluding the family home. The family home is already the biggest loophole in our tax net. It's 42% of our assets. What hope do we have of encouraging productive development if we leave that out of this particular tax? So that is a massive issue, and I do agree with Susan there, and that the Mansion effect is a concern for me, because we are talking about putting a capital gains tax on all other forms of asset except the family home. So I think that will drive even more people to the family home. And if you're wondering what the Mansion effect is, look at what John Key bought when he bought in Parnell. Bought the place next door, swimming pool, tennis court, sweet. No house there anymore. That is the Mansion effect, folks, in action. And it does have a real effect on housing supply. So, there's been a lot of talk about the Minority Report versus the main report. Minority Report is not a science fiction movie. Well, it is, but the Minority Report is so the main report basically said capital gains tax on everything except for the family home. So that includes farms, shares, businesses, including that fish and chip shop that Jacinda worked in Matamata, was it? That's where she got her small business understanding. So that is part of the issue that the Minority Report raised. They feel that actually, and this is what the Tax Working Group found, that the tax on business and business returns is actually high enough in this country. Businesses, most of them except for the multinationals, are paying their fair share of business. This is what the Tax Working Group found. And the Minority Report said, well, so why are we putting another tax on top of that? So they said just restrict it to investor housing. Okay, so that's the difference between the main report and the Minority Report. So, which way do we go with this? This is the horns of the dilemma that this report faces going forward. Because once you exclude owner-occupied housing, if you just tax investor housing, investors sell up, and you do get a few more people entering the housing market. That's a good thing, but rents will go up by quite a lot, because investors are looking to recoup their losses, and there's going to be less people renting their buildings. And by the way, rental houses have a lot more people living in them than owner-occupied houses. So this will impinge that rental supply quite a lot. And some people don't have a choice but to rent. They're the poorest people in our society. If you just put this tax on investor housing and nothing else, you actually can't raise enough revenue to compensate poor people for the increase in rents. That's why, I think, cynically, that's why the Tax Working Group suggested that we include businesses and shares. Because they needed to raise more revenue, not because they thought it was a good idea necessarily to tax businesses more, because, like I said, the Tax Working Group said that basically we tax businesses enough at the moment. I think cynically they did it to raise revenue so that we can afford to compensate poor people enough for the rise in rents that they're going to face. So this is going to be the real horns of the dilemma that the government are facing going forward, because obviously Winston Peters doesn't want to tax businesses. Jacinda's been waving about it. I think I agree with Dominick there. If you're going to include investor properties, you've got to include farms, because they're basically the same business model. Jack up your costs, keep your taxable income down, and take the capital gain when you retire, right? Those are the business models for those two. So they've got a real dilemma here in terms of what they include in this capital gains tax, if it gets across the line at all. Because if you just take it down to investor housing, you can't actually raise enough money to make this thing a progressive tax, which I think will be a real concern. So, just to round off, as Susan said, you know, there was this other option that was looked at, the risk-free rate of return. It's, you know, to explain it simply, it's basically saying that each major asset you hold has to pay at least as much tax as if you had the money in a bank. So, bank at the moment, as Susan said, is earning 3 or 4%. What tax would you pay on that? 25%, 33%, something like that. So you're looking in the realms of paying a 1% tax on the value of that asset each and every year. Each and every year, like a rate, like rates. So that's the risk-free rate method. A hell of a lot simpler, and it will hit unproductive capital investments. Businesses already pay more than that, so they won't pay any more tax. Okay, so it really does target those unproductive investments, such as, you know, farming and property. So that is the Opportunities Party policy, by the way, including the family home. But as Dominick says, you know, the politics are interesting. So that's my spiel.
Quick question off the back of that. That basically is the Opportunities Party policy, I guess. There. I was just wondering, can you hammer home while we've got you here, who is affected by the Opportunities Party policy in terms of, you know, you said the policy essentially collects more revenue,
yeah,
and who benefits from that?
Yeah, well, again, when you include the family home, as Susan said, you know, most of that equity in family homes is tied up in very expensive properties. It generates a hell of a lot of revenue, and you can actually afford to then reduce income taxes by a lot, you know, between 1/4 and 1/3. So massive benefits you can have in terms of reduced income taxes. And like I said, there's a lot of people saying that's what we need to do in the future if we're going to encourage people to get into that more green and sustainable economy. We will need to reduce income taxes. Now, our modelling suggests 80% of people are better off from that. Of course, you know, you get into government, you have Treasury to model that for you, and you can come up with more accurate estimates. But that's what our modelling suggests. Yeah.
Thanks, Geoff. Just to touch on that as well, when 80% of New Zealanders are better off, you know, a pretty fair assumption to make is that the 20% at the top are too, because everyone wants to live in a prosperous New Zealand, and inequality doesn't really help with that. But I would just like to do thank yous now and say a massive thank you to our amazing speakers for taking the time to join us tonight. I mean, yeah, a wealth of knowledge in one panel, and we're really fortunate to have you, and thanks for taking the time. And thank you, of course, to all the volunteers for making this happen, to Greyland RSC, and also to you guys for coming out and for actually caring. It's really nice to see an audience of this size that want to get educated, want to know more. And I guess if there's anything that you can take away from this, it is please talk about it. You know, kōrero, have a chat about tax, talk about it to your family, your friends. It's just about knowing that there are other options available. There is, you know, a way to tackle this in a better way than perhaps the current working group has done so. So if you take that away, I mean, that's, you know, something that I'm sure all the panellists could agree would be an achievement for the evening. But with that said, I thought we can all talk about it together now. So do we have any questions? I'll open it up to the floor. And do you want to come up to the mic? Are you comfortable? You can shout? Okay, I'll repeat it, yeah.
So I just had a question. I'm not quite sure who could answer this, but is there a country that you think has really got their act together on this tax issue?
Is there a country that has their act together on this tax issue? There are certainly countries doing it better.
I'm happy to. Oh, do you have to do it?
I can bring it over to people, and then we'll give them each a chance to.
Yeah, I mean, I suppose the first thing to note is New Zealand, I think, is one of 3 OECD countries that does not have a capital gains tax. So it is absolutely clear. All of the major IMF, OECD, they all recommend a capital gains tax for New Zealand to broaden the tax base. I mean, I guess you have to go through all of the countries and know the ins and outs. My view, Norway's got a really interesting, they've got a flat-out wealth tax, which is quite an interesting approach. Anyhow.
Thanks, Dominick.
You go.
Kira, and before I forget, thank you, Geoff, for inviting me along and mispronouncing everything. As a tax specialist, I deal all around with other jurisdictions all around, and Dominick has just hit the nail on the head. We are one of the only 3 jurisdictions that does not have a capital gains tax. Then we compound that by not having a wealth tax. Now, you can talk about Trump and today, but it's still interesting that the Americans kept their estate taxes there, and in jurisdictions that they don't have a CGT, they do have a wealth tax. We don't. And so it has the whole compounding effect, is all that Geoff, my other 3 compatriots, all said and explained very, very clearly. We do a lot well in this country. The GST system is very clean. It has issues. I wonder if it's fit for purpose in the digital economy. There is, the Sky story is quite interesting. I was asked to look at that for the spin-offs. We'll be read tomorrow on that. Sorry, this is a plugging stuff. But we don't have payroll taxes. Andrew Coleman made some very interesting comments about that. We have a very clean system. We just have 3 main taxes collect $80 billion, and no other jurisdiction is able to get close to that. And that speaks well to the efficiency. The system here is it is lean, but it has holes, and investment has been directed towards that. And I should say, I wear a hat on the Government Small Business Council. And one of the things we're looking at is this question of allocation of resources. Because with money going into housing, small businesses that don't have houses, businessmen who don't have houses can't get access to funds. And I notice, I'm really pleased to see there's quite a few young people under 30, 35 here. You ask those groups how they find funding to get into business. If they haven't got a house, they can't do it. And Dominick can talk all about that. So our system is screwed, and it needs to change. And if not having a capital gains tax was so good, why aren't we the richest country in the world?
Yeah. Oh, you want to go, Susan? Yeah. I'll pass it to you in just a moment. So I really want to quote that point on access to finance for people in small business. I think that's really important, Terry. And I really do find that when I talk to younger entrepreneurs. If I can the way I look at this, I can characterise the systems around the world in 2 ways. So, like I said, our big problem is we tax other assets, KiwiSaver, business, bank deposits up here, and we tax property down here. Okay. What some countries in the world do, places like Belgium, Switzerland, the Netherlands, Slovakia, Iceland, they tax the family home. They tax the shit out of the family home, up to the level of all other assets. Okay, so that's kind of what we're proposing. But there is another way. The other way is what a lot of the Scandinavian countries do, and they say we're going to drop. Everyone thinks Scandinavian countries are so progressive because they have really high income taxes, but they put all that money into reducing the taxes on investments, bank deposits, businesses. Their retirement savings in particular get taxed way down here. Now, there's inequality impacts from that, of course, because you're taxing people with a lot of assets, very little. But that gets rid of the differential between how you tax property and other forms of assets. In these countries, if I've got money, do I stick it in the family home or do I stick it in my KiwiSaver? Makes no difference from a tax perspective. Here, big difference.
Just a comment on trying to compare ourselves with other countries. I think one of the problems is that you can't look at tax in isolation from what you're doing in the transfer side or in things like health and education, all the things that government spending does to make our lives better. So when the tax working group looked at how efficient our system was in terms of redistribution, it found that we didn't fare very well, that our tax and transfer design is not nearly as good as many other countries. So they were suggesting, for example, that we should be doing far more through things like working for families. So one of the problems of capital gains tax, etc., being raised and the use of that money being seen as only to reduce income taxes is that we are overlooking the bigger problem, which is that we've got a health system and an education system and a welfare system that is so run down.